Welcome to the Plato Global Income Insights webinar. My name is Mark Cormack from Pinnacle Investment. Pinnacle are equity partners and work alongside Plato to distribute the Plato Australian and Global Shares Income Funds to the Australian financial advisory marketplace. And today we're going to take you through our insights on global equity income market in terms of what trends we're seeing, what's driving growth, and what's the outlook for global equity income. For today's presentation, I'm really delighted to have one of Australia's leading experts in the area of global equity income investing, Plato's Senior Portfolio Manager, Dan Pennell. As a bit of background, Plato have a unique approach to managing money by fully assessing the after-tax implications of their investments and delivering a high-yielding equity income solution in both global and Australian equities. And it's important to note that this strategy is specifically designed for low-tax investors such as retirees. So just to explain this a little bit further, because CGT is no impediment for low-tax investors, Plato actively selects and rotates through dividends to deliver a high-income solution. And in global equities, Plato have delivered over 6% distributed cash income since inception. And this is over 4% over that of the index, the MSCI World Index. This unique approach to managing investments for retirees and delivering income has resulted in Plato getting a recommended rating from the likes of Lonsec, and also Plato has ratings from the likes of SQM and Zenith. Today's webinar is going to last around 15 to 20 minutes and will be followed by a Q&A session. And all attendees do have the opportunity to ask questions via the questions tab on your screen. So without further ado, I'd like to welcome you to Dan Pennell's presentation today.
Thanks, Mark, and hi to everyone listening out there. Many of you know we're a specialist in providing solutions in retirement income, and we've been running a successful domestic fund for some time now. Hopefully, many of you heard Don Hampson, who's the head of Plato. He ran a webinar a couple of weeks ago where he discussed the domestic income environment. Just by way of background, 4 or 5 years ago, some of our larger clients came to us and said, look, we love what you're doing domestically, what can you do in global? They wanted diversification, but recognised that ongoing issue that passive investments in global really offer very little yield. And consequently, we've been running a global fund now for over 3 years, but we'll touch a little bit more on the fund later. We've been researching and investing in the global income landscape for some years now, and we've just initiated a quarterly newsletter to try and help some of our clients understand just a little bit more about what can be a really complex environment. When we talk to investors, we often find that a lot think there's no income in global shares, and sometimes their clients feel really uncomfortable with offshore investments generally. So the idea behind this newsletter is just to try and highlight some of those trends and the drivers behind those trends and put a bit of colour around global income for our yield investing clients. It's a pretty short note, purposefully, and this is to convey some headline stats and trends, but we've done it quarterly and put it up on the website, so please do log on to the address that's on the slide and let us know your thoughts. We want it to be client-driven, so do let us know what you do and don't like about it. Just by way of an agenda, the next 15 or 20 minutes I'll talk about the market environment, both looking back on our forecasts. We'll highlight some of those trends in global income and then pull it all together by showing how it's impacted investors in the Plato Global Income Fund that Mark mentioned just. I'm sure after that there'll be plenty from me, so we'll open up some questions as Mark said. So first of all, let's look at the environment. Firstly, what was last year like for investors, 2018? And I really want to reiterate the message that Don Hampson gave in that last webinar. 2018 was a truly tough year for returns. The global market, rebased in Aussie, was pretty flat. It returned about 1.5% for the calendar year, but it limped into 2019 with a really poor Q4. In Q4 alone, the global market, and here we use the MSCI World and Developed ex-Australia, was down over 11% in Aussie dollar terms. So investors' concerns, focused on rising rates, weak activity, the ongoing trade war, and high-flying growth stocks like the FANGs, which had helped run that big growth bull market, fell pretty hard, and Brexit issues continued to worry the market. One big change though, a bit of a silver lining in all of this, was that outlook for rates. That's helped the 2019 pullback, and I'll talk through that a little bit on the next couple of slides. However, a really key takeaway I want to leave you with is that in a period of tough markets, yield was strong and actually grew significantly. Yield, we feel, can often be overlooked, and it's been a substantial part of long-term returns for any client. The headlines in the quarterly show huge double-digit growth in global market income, and our global funds continue to pay 6%, so 3 times the market yield, with our domestic funds distributing its best ever yield last year. So again, that message, it was tough for markets, but great growth for yield. So the next couple of slides, just put a bit of context. Here we've got the cash rate expectations for just the major global developed markets over the next 5 years. And the key takeaway is that recent shift from hike expectation to flat or even falling rates in the medium term. And this change, to be honest, has been pretty recent and probably stimulated the start of 2019, where we've seen the best part of 9–10% pullback as that outlook for rates has changed. You can see just on these are out 5 years, and Germany, Japan down at the bottom, the red and blue, they're negative to sort of 0 over the next 5 years. Even up at the top, 2–2.5% from Australia and the US. The key takeaway is they're finishing 5 years pretty much where they started. So let's dig into it a little bit further, and just to highlight what I'm really talking about, we've focused only on the US in this chart. The US curve is in blue, and this is the 30-year curve taken a few days ago, 15th of February. And then if you look at the red dotted line, that's the same curve, but a year ago. And you can see a dramatic shift. If we just focus on kind of the first half of the chart, that 1 month to 5 years, so it's comparable to the one we've just seen, there's a steeply sloping expectation of rate increases on the red dotted line. Fast forward 12 months, the blue line has significantly flattened, and would say exactly as we just said, you're kind of at 2.5% throughout that whole 5-year period, and that's got a real impact on yield. So there's slower growth and expectation of flattening rates, and a lot of market commentary even highlighted a possibly inverting yield curve. Most recessions post-war have been preceded by about a year by an inverted curve, and that got a lot of market commentators quite concerned. And I just want to be clear, we're definitely not there yet. We're not saying it's going to happen, but the environment has shifted pretty quickly.
So it's interesting, Dan. What does this really mean, I suppose, for the outlook in 2019 from an income perspective?
Yeah, as you know, Mark, we every year do an income forecast the next 12 months, and it's pretty accurate. You can be a lot easier to forecast yield than it is return. And in short, finding income in a lot of those traditional asset classes is just really difficult for investors. If you look on the left of this bar chart, TDs, 10-year Aussie bonds, they're only delivering around 2%. As we all know, the domestic market's a good yielder. That's offering 6% gross, which is one of the highest globally. But you can see there our domestic funds outstripped that huge yield last year, topped up by buybacks, which we predict could continue to an extent in this forecast. But today's focus, as we know, is global, and that's the 2 red bars. There's been a bit of a price pullback, and in the market, we've gone from just under to just over 2% as a forecast, but around 2% long term. And we're delivering 3 times that, so 6% in the fund. I think just an interesting point to note is that it's pretty compelling at 6% in global, but also it's comparable to what you're getting out of a passive allocation domestically. So I think that really strengthens the argument. So a very quick look at the macro. It's a pretty quick webinar, but I want to focus on the income environment itself. The next few slides show some of the high-level growth stats in that quarterly newsletter I mentioned. And we just then want to look under the hood and examine a couple of the drivers of these trends, what's actually behind them. So time and time again in this presentation, we see that growth in income is really strong. And just for clarity, we're doing developed market only, so no emerging. We're using the MSCI World IMI, the broad index for all this analysis. But as we know, Q4 was pretty weak. As I said earlier, in Aussie terms, the market got smashed over 11%. But if you compare Q4 2018 to the previous corresponding Q4 in 2017, Aussie-based dividends grew 17%. If you look at the chart there, we've got the last three Q4s, 2016, 17 and 18, and you can see that both Aussie and global yields have increased significantly. Just to highlight this really positive trend, 59% of companies that paid dividends in Q4 2017 actually increased in Q4 2018, whilst only 6% reduced. So there's a reason we look at quarters, and there's some really interesting patterns for global yield investors through the year. There's a lot of different periods of dividend paying that companies do. It's often quarterly in the US, a lot of big European annual payers. And if you compare Q3 and Q2, Q2 is a much bigger dividend paying quarter. So this is driven by the companies that pay at that time, and they tend to be European. So the total dollars in Q2 are about 50% higher than in Q3, and again higher than in Q4. There's much more significant contributions from European countries like Germany, France, Switzerland, and driven down at the stock level by Nestle, a Swiss food company offering about 3%, German telco, Deutsche Telekom, 4.9%. But with a lot of these, the interesting thing is they pay one big annual yield, and that's in that Q2 period. Despite this, just to mention, the fund actually has paid regular monthly distributions, which has been fantastically received by our clients.
So Dan, it's interesting, we get a number of questions from advisors in and around dividends, and is there any deviation in terms of the quarterly income with regards to the annual picture?
Yeah, look again, Mark, the annual picture is strong growth. In this slide, we've put all the divvies in our universe over the 2 years, and you can see that headline number, growth of dividends is 12.6%, giving a massive 1.8 trillion Aussie paid out in the last calendar year. So we're seeing growth quarter on quarter, but to answer your question, also strong in an annual perspective. One really important thing to mention that's often overlooked is the impact of currency. As we all know, for Aussie investors, it can have a real impact on what you actually get at the end of a period. And the Aussie's been a good diversifier. It's correlated with global markets, so when markets fall, you often get a bit of a boost because the Aussie falls with it, and when you move your returns back to the domestic dollar, you get a bit of a boost. And that was indeed over this period, 17 to 18, the Aussie was pretty weak, broadly, and it actually boosted about 4%. So of that 12.6, just under a third of it was from currency, a real diversifier, but as I said, just something often overlooked that's really important. Just again, to put a bit of colour around it, if we dig down to the company level, over 1,300 companies in our universe increased their DPS, which is the dividends per share. So not the yield in percentage terms, but the actual dividends they're paying per share. And in comparison, only 148 actually decreased.
Okay, it's interesting. Growth rates have been impressive, but what's really driven them, mate?
Yeah, we've just done this by country and sector to try and get a bit of flavour of what's behind these changes. And you can see on this slide 13 some of the larger percentage increases by country. And you can see Austria, Singapore, Germany, really significant, 25% plus percentage increase in dividends in that calendar 2018. To be honest, Mark, dividends rose pretty much across all developed market countries. I mean, the only exceptions really were Israel and New Zealand. Everywhere else, there was some pretty strong growth. Again, just another important thing that can often get missed, the US tends to be a lower yielding country, and it's not on here by percentage increase, but just the sheer size of the US means that it contributes a significant chunk of global yield. Interestingly, look, 70% of US companies that pay divs actually increased or initiated from zero in that quarter. So despite the fact it not being a huge percentage increase, 70% of those companies increased. However, just another kind of note is that only just over half US companies pay. So in Australia, for a comparison, there's 85% of companies pay a dividend, whereas in the US, only 55%, so just over half, pay a regular quarterly dividend. As I said, that's country. What about sector? So again, strong growth. All sectors except materials saw growth in Aussie divs, paid versus that previous corresponding quarter. And as I said, we do the quarter on quarter just because there's a different quantum of yield paid, so you want to compare apples with apples. The largest percentage increase globally was actually from IT. Traditionally, IT marks a pretty low-paying sector. A lot of the FANGs headline stocks in those sectors don't really pay much income. That grew 33%, so a third increase in its yield, driven by names like Broadcom, Visa. They were up 51 and 31% respectively. The next largest sector, staples, just under 18%. So some, again, pretty big drivers at the sector level. So that's driven the income. A really key part of income investing is dividend traps. People who cut their income, and we run an in-house dividend cut model, and that gives a bit of insight into where we forecast, where we think future dividends are going to go. So apologies, looking at these slides, that scale might not be too clear, but the wiggly line's our model. And you can see here, it suggests on the right a pretty small chance of a dividend cut. That's around 10%. Despite a recent share price weakness, which can often mean yields might come down, 10% is pretty low. And just to kind of contextualize it, the big peak is the GFC, and now it was 35%. So we expected a 3 or 4 times the chance of a dividend cut that we do at the minute. Really, the key takeaway, Mark, is that overall our forecasts are pretty strong for income going forwards, and we don't see the likelihood of big cuts.
Okay, with time running out, mate, do you mind just giving us a bit of a summary and what this means for investors?
Sure. As the domestic fund Don highlighted in the recent webinar, we've got dual targets. So we want to outperform yield 4% and also on a total return. It's really important not to ignore the total return and have concentration risk. So we construct a diversified fund. We don't just blindly overweight high yield areas. We want to focus on yields on this webinar, and these charts show the high level of yield for investors in the actual Plato fund. On the left, you can see annual income in red, and the comparison, the index in blue. And as I've said, we're delivering about 3 times due to our rotation strategy. It's been consistent, and on the right, you can see a cumulative yield. So this is, again, just yield, and you can see there we've consistently offered a lot more than the benchmark. Finally, I just want to highlight growth in income. On the left, that 12.6%, the growth in the market and global yield that we've talked about earlier. But to compare, I've plotted the increase in the actual CPU, so the cents per unit, again in Aussie dollars, of the actual fund itself. And not only have we generated higher yield, but the growth in that yield's been in excess of an already pretty impressive market number, that 12%. So overall, we think it's a compelling story for income-focused investors in a tough environment. So, in summary, the rate environment's changed significantly. As we saw earlier, this has put pressure on traditional asset classes that investors use for yield. In an environment that's had significant risks, domestic housing prices, trade wars and Brexit globally, yields are a really important part of total return for clients. As we've shown, if you want to invest globally, many people want access to diversification, to growth. Income really shouldn't be a barrier. You can generate high income with solid growth in that income from an allocation to global developed shares.
And Dan, we have had a number of questions come in. It does seem to be a fairly topical presentation.
Great.
In terms of, you mentioned global technology companies out there. Traditionally, they haven't paid a great level of income, as you mentioned. Are there any global companies that are paying decent income at the moment?
Yeah, there is, Mark. It's very topical, and tech, as I said, is traditionally not really a high-yielding sector, but you really want to participate in growth and find yield. We limit sectors to the index, and we do the same on countries, and that's to give diversification and participate in things, even if they're not necessarily really high-yielding. I think we all read about the FANGs. Those FANG names are always growth stocks that are in the papers, and they don't really pay yield. That's been a bit of a headwind for the fund, but we participate through names like Seagate. That's more on the hardware side, the hard disk drives. That's got over 5%, about 5.5% income. Cisco does IP, Internet Protocol Networks. They're just under 3%. And again, HP, that's also just under 3%. So there is names out there that pay really good yield and are kind of solid companies. I think we're just a little bit different. We do things like Swiss company Logitech does a lot of your peripherals. Yep. Seagate does a lot of your hardware, as opposed to those software companies, and that's how we're participating in IT.
Yep. Interesting, relating to that question, and I know a lot of global tech companies are based in the US. What allocation would Plato have in the US, considering in general, the question goes on to say it's a low-yielding market, but can still have capital growth?
Yeah, if you went in the US last year, it could have been pretty painful. It's 62% of the world. But we do plus or minus 5% versus the index, so the lowest we'd ever be in that's 57%, so still a big chunk. And there's some massive high-yielding names in the US. It's just overall, it's a fairly low-yielding country. So as I said, we want to avoid concentration risks. We don't blindly just go into utilities in Europe, areas that are traditionally higher yield. So yeah, we've got in excess of half the fund, but we're still at that maximum underweight often in Japan and in the US, where yield tends to be lower across the names.
Yep, and that'll be circa around that 5% mark.
Yeah, that's our constraint limit, just to create diversification. Otherwise, you can be pretty concentrated, and in certain market environments, that's pretty painful.
Yep, no, absolutely. A question I get, and it's come up here in the questions, is you guys are generating a great level of income. Do you use derivatives to generate the income?
Yeah, we get asked a lot when we're moving around the country, but no, we don't. We're an equity-only fund. We have no derivatives at all. We're fully invested. Equity only. We want to keep it quite simple. The strategy is rotation, and that's the way we generate really high levels of income. We're not using derivatives.
Just in terms of stock holding, question here in relation to how long do you have to hold the stock? Are the rules like you have here in Australia, where you've got a 45-day rule in order to get a franking credit? Are there any constraints in terms of global equities?
No, there's not. You can hold it a day to get the income, but we want to get the run-up of that stock. Yielding stocks tend to outperform in that period that runs up to their X date. And so we tend to chart that for about 3 months, but you see a bit of a pickup in the last month. You see the price increase slightly. So there's so many opportunities globally. There's literally thousands of dividend-paying stocks that we tend to hold it for a couple of months, take that run-up, get the yield and move on, but there's no restrictions like there is for our domestic fund with franking credits.
Yep, okay. Another question here, Dan, in relation to the pattern of income during the year. Does that mean you pay one major distribution? How do you guys manage that?
Yeah, we actually pay out monthly. I don't think many products do that, but for retirees where we're focused, I think when you're not getting a salary, we've had some fantastic feedback that getting a consistent monthly income is an incredibly good way to be able to run your own finances. We don't want that to be too lumpy. As I said, there's a bit of cyclicality around Q2, but there's not a lot of points of saying we're going to give you monthly income and then giving you hardly anything for 10 months, then a huge income. We're income only, so it's not CGT. We would obviously distribute, you have to, but we haven't. So our 6% has been just cash income distributed monthly in the back pocket of our clients.
Fantastic. Look, Dan, that is all we do have time for today. We certainly appreciate the questions that came in. So we will wrap up the presentation today. We will be making the presentation available on the Plato Investment website, which is www.plato.com.au. We'd certainly like to thank everyone for your participation today. If you have any further inquiries, please do not hesitate to contact the Pinnacle distribution team. We certainly look forward to chatting with you at our next Plato webinar, at our next luncheon, or at our next meeting with you in your offices. So thank you very much and have a great day.
Thanks, Mark.